Well, the markets ultimately end up sleeping through another day. A little bit of jostling in the Nasdaq, a little bit of pre-positioning for today's earnings release bonanza after hours. And as we look at the markets, they haven't done much of anything with it. But where there is action is in the currency markets, and that's where we are going to take this conversation. Look at the incredible strength, despite all the naysaying at the BRICS summit last week, of the US dollar, which continues to power higher. And so the question that we're going to ask ourselves here is whether that will continue, and if so, what will be the driver going forward. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the focal point for our conversation today is going to specifically look at what has been one of the weakest parts of the US dollar's performance, with the sort of background of what's happening economically, but strangely, a place where it has done the best, especially recently, against those very currencies that should be holding up strongest. Here's what I mean here. Take a look at how the dollar has precipitously fallen in Australia while its US counterpart has marched higher. And this is perhaps the most interesting illustration of the ascendancy of the US dollar in recent weeks. This is 5 consecutive weeks of gains for the US dollar against the Aussie. And in fact, a push through critical support here at 65.78 on today's session. What makes this so remarkable isn't so much that the dollar is higher, it's higher against virtually every major currency in the past 4 or 5 weeks. It's that the Aussie is very much the odd one out in that its central bank seems disinterested in rate cuts. Gains for the dollar against the euro, for the pound, come against the backdrop of the ECB cutting rates, the Bank of England cutting rates, Bank of Canada cutting rates, Bank of Japan diluting what modest rate hike expectations they had. Granted, they were paltry to begin with, a further 10 basis points maybe by the end of next year. Nevertheless, some of the recent turmoil in Japan has helped that situation find a ceiling. And yet, despite the fact that the RBA is perhaps the most hawkish of the major central banks at this point, and certainly a far cry from the Fed that has already initiated its rate cut cycle with a big 50 basis point reduction, the Aussie can't seem to find a bottom. It is, in fact, doing worse than the euro or the pound or many of the other major currencies against the dollar. And this, of course, makes for an interesting sort of setup where you almost get the sense that the markets are, in their usual forward-looking way, anticipating that while these other central banks have already started cutting and that's in the price, the RBA is yet to be convinced and so has everything to price in yet. Take a look here at the relationship so far. You can clearly see that what's happened with the Aussie has largely followed the evolution of the Fed's view as the markets anticipate what the Fed might do now. And what we find here is, in the orange, is the implied Fed funds rate December of next year. So that's baking in all of the rate cuts that we're going to get between now and next year. And in the darker line here is the Aussie. And we can see here that the Aussie does relatively well as those rate cuts get built out. So when there's more rate cuts, that is, the rate is lower, the Aussie does well. When there's fewer of them, it comes back. It's been a very clean inverse dynamic. And most recently here, this most recent Aussie dollar sell off right here, that's this move. This we can clearly see follows a hawkish rethink of what's going on with Fed monetary policy and just how many rate cuts the Fed is going to be able to deliver. Not surprisingly, this comes, as we've discussed here at length over the past several days, thanks to a very different landscape on US economic data. So what we've seen here is that US economic data, looking at this index from Citigroup that measures its performance not in absolute terms, but relative to forecasts, we've seen that what this has done is create a situation where there is about the best performance that we've seen out of the US economy since back here, where really the deterioration that then led markets in the beginning part of the second half of the year to start to speculate, well, maybe the Fed is going to be behind the curve. Maybe they should have cut already. It is here, as the Fed is resistant to rate cuts, that we find a situation where suddenly the US economic data picture starts to get soggier and the markets start to think, oh, well, the Fed's resistance to cutting is going to miss the board. They're going to be way too behind on this, which is why when Jay Powell ultimately introduces the idea of finally starting to cut rates in early July, the upshot from markets, stock markets that is that this isn't good news, that this is bad news, which seems, needless to say, counterintuitive. But what we find here is that we have a situation where this time around, the markets seem to think, well, if they're resistant to cutting now and the economy is deteriorating, every single time they wait, they get further from the ball, and that's more cuts that they have to do next year. That's not risk positive news. And so what ends up happening here, as we can see, from mid-April, early May, is that while the outlook for this year, in the gray here, this is what's implied in Fed funds futures, while that holds relatively steady, the outlook for next year starts to build out and gets increasingly more dovish. Here's July, where the Fed announces that it's go time and the markets do not have the best reaction. Incidentally, we'll notice we don't really get a break of these highs from the S&P until the cuts actually arrive, and that ends up being the bearish, or the dovish, we should say, extreme for the cumulative rate cut outlook in 2024 and 2025, where it peaks at 229 basis points. Since then, needless to say, there's been a rethink. And of course, that lines up directly with what we see right here. US economic data starts getting better. We go through the zero line, which tells us that at this point, US economic data is surprising more so to the top side than the alternative. In fact, it's actually tilted toward upside surprises, and it's by the largest quotient since here. And again, last time we were here, the cumulative 2-year rate cut tally was a mere 3 cuts. Now, it's a little bit more when we look now, and if we consider that the markets still anticipate that the Fed is likelier than not going to deliver at minimum one more cut over its next two meetings. In fact, the markets are pricing in 33 basis points in rate cuts through to year end, which means one cut is all the way in. And there's about 8 basis points of a second one that's baked in, giving it a probability of 32%. So at least one more cut on the menu here, and another one not quite better than even odds at this point. But of course, that speaks exactly to what we're talking about, this dilution in expectations. If we look at what the markets for the Fed anticipate for next year, it's a mere 84 basis points. So we're still to the dovish side of where we were sort of at comparable areas in the outlook here. But when we consider the trajectory sort of overall, it's very clear what is occurring. Here's the 50 basis point cut, but then everything since then looks increasingly less dovish. Everything following from this upshift in the data, and we can clearly see what the impact is on the Aussie dollar here, despite, again, a very resistant RBA. Now, over the next 24 hours here, a bit less, we're going to get the update on U.S. GDP for the third quarter, the expectations that we're going to get an annualized growth rate of 3%. That would be unchanged from the second quarter, but also land us somewhere in the middle of the normalized range after this COVID volatility here. Obviously, we can see we had a giant 28% drawdown at the height of the pandemic's impact, then a rapid 35% rebound once that abated. And since then, we've sort of carved out a range here, which most recently, let's say from the end of the Fed's rate cut cycle in late 2022 thereafter, so right about here, has carved out a range from essentially about 2%, 1.6 is the low, up to 4.4. So if we get a sense of what that looks like, 3% is sort of right in the middle of where that is. But when we consider, again, what U.S. economic data has been doing here, the risk seems tilted higher. The risk seems that we surprise on the top side. And indeed, that has been the order of the day for most of the recent top-tier U.S. economic data. Of course, a bit of a miss on JOLTS today, but that's 1 month lagged relative to everything else. And the more recent PMI, retail sales, employment numbers even, all of these things have looked better than expected. ISMs. And so when we look at all of this in aggregate, the risk seems to the top side. And of course, that would only mean more of this. Less of a dovish view on the Fed, more pressure on the Aussie. What makes this week particularly interesting, though, is that we might finally get some help on the domestic front. So here we are with Australia's third quarter CPI numbers, which also are on the menu for today. Those are expected to give us a headline inflation rate at 2.9%, which would be the lowest since the first quarter of 2021. The core reading here a little bit more modest, stripping out some of the more volatile categories here. And Australia has a little bit of a different way of doing it with what's called a trimmed mean. So rather than taking out energy and food, which are volatile and which is what most statistical agencies do, the Australian Bureau of Statistics just takes out the most extreme increases and decreases and gets a sort of centered average for the core. And here, coming down to 3.5%, obviously a bit higher than the headline, but nevertheless moving in the same direction. the monthly CPI indicator, the relatively more recent advent, not the official one that the RBA looks at, but of course still from the same statistical agency. This seems to suggest that we are looking at a move in the same direction, and indeed a movement much closer to where we would be were we to be essentially at target. So the monthly indicator to 2.3%, not quite enough, needless to say, for the RBA to declare mission accomplished, but perhaps enough for the RBA to say, well, look, we were not looking to cut, but perhaps there is still something to do here before year end. Perhaps there is still something to do here vis-a-vis policy that's more dovish next year. As it stands, the RBA is only pricing in or priced in to do in benchmark bank bill futures 7 basis points in cuts this year. So needless to say, the probability that you get a further move here almost nil before year end, only 7 out of 25 basis points in a move obviously make for a less than even chance that that move occurs. For next year, we're baking in 54 basis points, which amounts to 2 standard sized quarter point cuts. And if we look at the way that this benchmarks to what the Aussie is doing already, if we get a miss on this CPI data in line with some of the weakness we've seen in Australia's economy, well, then the situation starts looking, if not more dovish for the probability of a late year cut, then perhaps for a deeper easing cycle next year. And in this sense, the evidence seems compelling. So looking at the PMIs here, we can see for 2 consecutive months now, Australia's economy has contracted. The pace of contraction eased a little bit in October versus September, but when we consider what the economy did in that third quarter, which is what's going to be most impactful on the CPI release today, that's this. And collectively, this amounted to the worst performance since this late 2023 recession. On 2 out of 3 months in the third quarter, the economy shrank. There was a big pop here in August, but outside of that, the economy was mostly in contraction mode. And indeed, when we look at the way that S&P Global and Judo Bank, which co-authors this, the way that they described what was occurring with price dynamics here, what they're saying is that overall price grew at the slowest level. This is output prices, both services and manufacturing, since December of 2020, which sets us up for a situation where indeed those CPI numbers might miss. Now, if we look at the implications of all of this put together, the Aussie has obviously had no issue going lower without a dovish pivot from the RBA, and in fact, an RBA that has been loudly screaming in the opposite direction. But if the CPI numbers come in soft, well, then they may have their hands tied, or at least the markets may look at this and conclude, well, if we thought we had 7 basis points priced in for this year, maybe it's more like 15 or even 20. That wouldn't necessarily be an earth-shattering change, but it might well shift the needle and give the Aussie a further at-home reason for weakness, on top of everything that's going on with the Fed. Couple that with US GDP data that's likely to keep the existing narrative humming along. And then what you end up with is a very good reason why the Aussie might find follow through on this break through this support at 65.78. The next key inflection point is this congestion area all the way back to 64.87. So the Aussie seemingly with room to go here before selling pressure is exhausted and the catalysts may well be up ahead. Now, if this were to go the other way, then at first, getting back over 65.78 and actually establishing a foothold there, perhaps managing even to get through this former low support, become resistance at 66.23, that would tell you that perhaps whatever this was is over. And although the trend, so much as we can clearly see here, this was a trend higher that got overturned, and we'll see if we can build the wherewithal to actually undo all of that. But even in corrective terms, getting back up here would suggest that at least the initial impetus has run aground, and now you're heading back maybe into the 67 figure at minimum for a retest. But as it stands here, the momentum is with sellers. So much so, again, that they took out a support level today before this data. And if the data confirms, then an extension this way likely follows. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm on with Chris again for Futures Power Hour, Mondays and Fridays. I'm also on with Victor Jones for the Price of Truth on Wednesdays, though that's off this week. And back with Victor for along with Tom for First Call on Sundays as the markets open in the Asia Pacific. I'm also writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.